today's Fed Day. We're going to find out what they're doing. There are a lot of people, including some economists we polled, that think that we may be moving faster and farther up with rate hikes. Do you think that's the right thing to do?
Look, I think it's too early to say. I think the pace of change should be, as they are doing, gradual. They're not rushing, but they are certainly being very intentful about it. And the question of where they should stop, I think, depends very much on what they're reading about the economy. What we see right now is two or three things. One is a labor market that certainly is very tight. Two, financial markets that are strong and have had a long bull run. But the flip side and the other side of their mandate is around inflation, and that's getting into their 2% range, but doesn't at this stage appear to be moving ahead of it. And so I think they're going to be balancing all of these things, trying to engineer what they're going to call, or what I would call, a soft landing. Keeping the economy going, but maybe not picking up on inflation.
So you just illustrated the sort of the Scylla and Charybdis, as it were, of the situation. Right. Because on the one hand, inflation is really not driving them to raise it. At the same time, those same economists say probably the most likely cause of recession would be going too far.
Right, and I think they're aware of that, which is why I use the phrase soft landing. And so to be quite clear, the current inflation is roughly where they want it to be. But their challenge, obviously, is to look over the horizon and say, well, what is inflation likely to do? Because they know that monetary policy works with long and variable lags. So they cannot wait for inflation to be dramatically above 2% before they start to move.
So should they be concerned at all about the inverting the yield curve? Because we hear conflicting things, including from Fed members, about whether they should be worried about that.
Well, first you start with the fact that there are conflicting messages out there. I think they should be keeping one eye on it, because I actually do believe that markets will be telling a bit of a story. You know, if it looks as though the short end, if the Fed moves up too quickly and the economy itself is not continuing to be very robust, they better listen to that signal for sure. But there are other signals they should be looking at as well.
At the same time that they're raising rates, they're also winding down the balance sheet. And we're looking toward the ECB. They're certainly slowing down their bond purchases. They're going to be stopping them. Liquidity is coming out of the global market. How big a factor is that for the Fed in deciding what they do with rates?
I think they're working with both of those things simultaneously. And so observing how they are moving their balance sheet is going to be part of their process. This is the first time they've had two separate tools to use, and I've observed they've been trying to manage both of them in a way that has two characteristics. One, gradual, and two, very transparent. So they're avoiding surprises. So I'd say thus far so good, and they're going to keep working both of them with one eye on how the market's actually responding and the other on how inflation and labor markets are working.
So let's have you wear both your hats now, both former Fed Vice Chair and your current position at TIAA. Where are we in the cycle, the business cycle?
There's no doubt that we are relatively far along in the business cycle. If one wants to use sports analogies, I don't think it's the ninth inning if one is a baseball fan, maybe seventh, eighth. So I think there's more to run in this, assuming that the Fed itself moves very, very gradually. And the reason I think there's more to go is optimism is relatively high among consumers. We saw a consumer sentiment index just the other day that's at high levels. Same thing is true with business leaders. Wages are only gradually but clearly starting to pick up. And so there are many forces, I think, that are going to continue the forward momentum. And I don't think the Fed has a desire to suddenly crunch this financial market condition whatsoever. I think they want to let it run as far as they can, assuming no big pickup in inflation fears.
So given that analysis of where we are, what does that tell you as an investor? At what point do you get more defensive? Is that time already come, or is it still to come?
I think the answer for individual investors depends very much on your risk appetite. If you're an individual investor and you would think, gee, a 10% correction and I would really toss and turn at night, this may be the time to start to gradually move a little bit more defensive. If you're an investor that says, I can tolerate an inevitable correction, I really think I want more of that upside, then I'd say you're probably okay being a little bit more risk on at this stage. But each individual investor has to decide for himself or herself what his or her individual risk appetite is. That's the way you decide how to deal with your portfolio.
You manage money for the long term. You have to think about pension liabilities coming up way out, 10, 20, 30 years out. Are you changing your investment profile right now at all because of where you think we are in the business cycle?
We're not changing very dramatically. We're thinking about the investment program for the next couple of years. And I'd say we're moving to places where we're pretty sure we're getting paid for the risk that might evolve over the long term. But we're not trying to swing the portfolio dramatically to prepare for anything, partially because, as you point out, we have to invest over the long time. And so it is not wise for us to try to do aggressive market timing. Rather, I think it's just trimming our sails just a little bit, taking a bit of risk-off posture in places where maybe we've been a bit more risk-on.
So be a little more specific. What does that mean? If you're just tweaking the knob a little bit, where do you tweak it? Is that a debt equity issue? Is it the sector of equities, cyclicals versus defensive? Is it international versus domestic? Is it emerging markets? Where do you tweak it?
Well, where we tend to tweak it is really more in the fixed income, where we maybe move from a little bit of what's called spread to more a credit focus. We certainly want to move up the ladder, if you will, towards the higher grade investment opportunities. And so that's really the way we're thinking about tweaking it.
Are you seeing any indications right now of creditworthiness deteriorating?
Not at the upper end. We do not see creditworthiness deteriorating at the upper end. We have taken note that we are getting more a little more high-risk credits that's starting to introduce into the markets. We're seeing the covenants starting to get a little lighter. And so at the fringes, we're seeing maybe some of the beginning of some overstretching in terms of the credit markets.
We'll put that together, the covenant light, as it were, and some more risk being taken, with the degree of leverage. Are you concerned at all overall with the leverage? Because there's been a lot of leverage taken on, in part because the interest rates have been so low.
Look, there's no doubt that many are observing that individuals and companies have been putting on a lot of leverage over the last 2 or 3 years, in part, as you say, because interest rates have been low. And so I do think this goes back to the earlier question. The pace at which the Fed normalizes and the shape of the yield curve could play through into, for some companies, not most, some at the edges, maybe feeling a little stretched, and possibly some individuals. So this feels to me as though it's more of a question of careful around the edges as opposed to a fundamental weakness in the society.
Explain one thing to me that I haven't fully understood, which is that we've seen reports that in fact pension plans have made different decisions because of the tax code, because there was an incentive within, as I understand it, by the end of September, the fiscal year, to actually go into a lot of debt that actually affected the yield. How did that work?
I think the reality is that you put your finger on it, which is the tax code did, for some, not for my company, but apparently for some, give them an incentive to stretch for that little bit of extra return at this stage. My view is all pension firms should do what we're doing, which is take a very, very long-term perspective, because you recognize, as you point out, that we've got liabilities that could exist for 20 or 30 years. And so our asset models and mixes should really think about matching the liabilities and the assets the right way.
One of the things we hear about is the demographics, global demographics, that as the population ages, there's more need for long-term money, essentially, which is just suppressing yields actually in the longer terms. Is that right? Do you see that?
There's no doubt that as pension funds, insurance companies try to balance assets and liabilities, it makes sense for all of us to be investing longer term. And yes, I think that has had some marginal depressing effect on interest rates in the long run, because that is what you'd expect when you start to find demand starting to pick up in that space.
Does that indicate that the yield curve inverting, it doesn't tell us what it once did because there are other reasons?
Right. Well, you put your finger on something that's really important. In the academic literature, there's really quite a debate as to whether the yield curve is signaling as it has in the past. First thing you recognize, the yield curve is not yet inverted, and so we're talking about something that might happen. And secondly, you put your finger on something else, which is both central banks and investors have been crowding in, if you will, to those longer term asset classes. Therefore, you're seeing the kind of results you're talking about, and there's therefore a debate as to whether or not the yield curve is actually going to be the precursor to the next recession, should it invert.
Your job requires you to really understand the pension situation in this country very well. We hear stories about public pensions, state of Illinois, the city of Chicago. We hear horror stories, frankly, about unfunded or underfunded pensions. Where are we in the private sector, not just the public?
Well, look, the statistics that I've seen suggest, broadly speaking, the American society may be short of retirement savings by anywhere between 4 and 6 or 7 trillion dollars. That's trillion with the T. So it is clear to me that we have what I'm describing now as a retirement challenge that we must confront. Otherwise, it could become a retirement crisis. Has not yet done that, but it's time for all of us to take the right actions to forestall a crisis.
Who is the us in that sentence? Is
Right.
that private corporations? Is that states? Is it municipalities? Is it the federal government? Whose responsibility is that?
The truth is, it is a shared responsibility, and us literally is us. So for the individuals, one, if you haven't signed up for a workplace retirement plan, do that. Max out as best you can on your retirement savings. All individuals probably need to save more. For businesses, and institutions, it is make sure you're offering a retirement plan and offering one that has the right kinds of options in it, which include both equity investments, but importantly, annuities, which are an insurance product that guarantees against longevity risk. For the government, it is creating laws that make for safe harbors for annuities, for example, and most importantly, thinking about how we're going to repair the Social Security system, which by 2033, the trustees tell us the system will be under a little bit more stress and strain.
We can put that on a to-do list for Congress.
There's a to-do list for Congress,
things.
Absolutely.
But finally, one of the changes we've seen since the last downturn has been the move toward passive. We haven't really seen a big downturn with this much money in passive. What are the ramifications of that?
Well, you put your finger on it, which is as we move toward passive, that means there's less money where you actually have a portfolio manager assessing the likely prospects and the strategy for individual companies. And so you are going to get bigger movements perhaps. Now my company has taken a very balanced posture here. We have both active and passive, and importantly, we have a very large holding of alternatives. And the reason we have that very diversified portfolio is so that we can smooth out the various cycles and therefore avoid the potential big swings that come from just having one approach.